we saw about $15 billion worth of signature dark pool prints between Wednesday, Thursday, and Friday of last week. You can see here we saw $5.3 billion at the 419.21 level. Seeing over $5 billion in premium is very, very rare in the market, especially anything over $3 billion is pretty rare, but $5 billion is a lot. If you go back to each day here, you can see Thursday, we saw 4.4 billion of signature dark pool prints at the 415 level. And then also if you go back all the way to Wednesday, you can also see here we saw 4.8 billion in premium at the 410.34 level. So that is a lot of premium. That equates to about 15 billion, which is exceptionally rare to see that much premium in the dark pools, let alone within a 3-day time period. And personally, just from looking at that data, they do seem to be sells. You can see up here just on this chart, this is a mini chart of SPY for the last 2 weeks. We did, of course, see a lot of that consolidation for over a month within this range here, and this was followed by a large up move. Now, the 410.27 roughly print that I just showed you right here, which would be 410.34, was 4.8 billion in premium, and that ended up being the low before we started this move up. So there was a potential that was a short-term buy by an institution prior to this large rally we saw to end the week. However, the days following, which I just showed you here, for example, Thursday, this $4.4 billion print at the 415 level seems to be a sell at this point. It is very rare you see this large of a buy from an institution after things start to rally, especially after how extended we are. Now just look from back here, we did see a lot of accumulation off of this downward trend line. This line goes all the way up to the top that we had from back here from all-time highs. This downward trend line, we saw a lot of accumulation via the dark pools, especially signature dark pool prints off this level. So that was a lot of buys, and this was followed by a large rally upward. But now, lately, we've been seeing a lot of prints again, and it's unlikely that these are buys, because when you're talking about institutions, they don't like to chase, kind of like retail does. Retail is known for being the chaser, and of course there can be short squeezes where institutions are squeezed out. However, it's unlikely they would execute those orders of having to buy back shares via the dark pool. It would likely be off of a lit exchange, which is the opposite of a dark pool. Those are the exchanges that you and I can trade off of, being retail. Remember, institutions are the only ones that can trade off of dark pool exchanges. So we did see a lot of that accumulation over here, followed by a lot of upside, and now we're seeing even more potential, in my opinion, distribution, and this would likely be the precursor to a lot of downside. Now, just based on last week's weekly candle, we did see a technical breakout of this orange trend line. If you are subscribed to the channel, you know this is the one from 2009 lows. And just because it's a technical breakout actually doesn't mean that it has to have continuation in this sense, or at least this scenario of this line, because we've seen a lot of times where after we saw a breakdown below the level where we had a weekly close back above, as you can see right here, another weekly close back above, and another weekly close back above, and every single time it actually was the start of a new downward trend. So this week is very critical because we have yet to see 2 consecutive weekly closes above this orange trend line. Remember, every single time we've seen a weekly close above, it has prompted a rejection that following week. So if this were to be the case, we'd have to see a rejection and weekly close below this roughly 415 to 416 range at the end of this week. So it is a scenario where the ball is in the bear's court. They need to capitalize on this, because if we have 2 weekly candles above, then that really changes things up for potential of a lot more upside, since we have not seen that before here. So do keep that in mind throughout this week. Another thing I want you to keep in mind is actually the VIX call flow that we saw from last week. It's pretty rare to see a lot of call flow on the VIX, and if you just go to the historical flow tab here and type in the VIX and then also filter, I like to typically filter for about 500,000 in premium for the VIX, and then click search here. You can see we saw a lot of calls, 83% calls actually to 17% puts, just from last week alone. And you can see a lot of these had a ton of premium behind it. We saw this 1.2 million in premium out the money for this 719 expiration. And then the really crazy one was this 9.1 million in premium for the 27 strike, and also for 621 as the expiration. So it is not common to see a print like this, especially for 100,000 contracts. That is a very large print overall. This is likely a hedge heading into the debt ceiling time period. We know that that window is about early June-ish for the time period that we're expected to make some form of a decision, and if not, that could have repercussions on the market. So this is likely a hedge for that, but nevertheless, a large print. And also, if you keep going down, we've seen a lot of similar prints. This 8.9 million in premium for the 25 strike. This one has a little bit extra time in it. This is for August 16th, but still 8.9 million is a lot, especially for a VIX call. We tend to see large orders on the VIX, especially when they come in consecutively, but we tend to see them about 500,000 to 1.5 million-ish. And to see something like this around the 8 million to 9 million range, that is a lot of premium behind a call order. And you can also look at all the other ones, 700,000, 700,000, 600,000, 700,000, etc. A lot of calls from last week, and you can just keep scrolling down. You could see just a ton of them. Also for that 8/16 expiration, another 25 strike for the 5.3 million in premium. So big money has been accumulating these as of last week, whether it is a hedge for the debt ceiling deadline that we have here approaching or an actual directional bet. We do not know. However, this is something to keep in mind. And typically when you see consecutive call flow hit the tape throughout the entire week with a lot of premium like we saw last week, that tends to mean there's going to be some form of a spike in the VIX soon following that. Again, whether it be a hedge into the debt ceiling deadline or a directional bet, you tend to see a spike following a lot of this call flow soon after, regardless of the intent of the orders. And this is also fitting in terms of time because we did have, as you can see from back here, we did have VIX expiration occur already. That was last Wednesday. So all of those VIX options, at least for the May date, expired, similarly to how we have all the options. Contracts expire on Friday for May 19th. That was OPEX. So we did have all of those VIX contracts expire. So that does give some leeway, especially this week and next week, for the VIX to actually have an attempt at a breakout. At least, again, the ball is in the bear's court to attempt for that breakout. It doesn't have to happen, but there is that opportunity here in this window of time period. So watch for something like that as of this week and next week. And we're right on this yellow trend line right here. This is the one that goes back to 2017. So it's been pinned to this line about a month now, as you can see from back here in late April. So I would like to see a bounce from this line, especially after all of the call flow we saw from last week. And last note for this video, the Dow has seen a rejection again off of this channel from up here. We saw it last time over here where we had a rejection out of the middle of February, and it rejected all the way down to the downward trend line from all-time highs. As you can see over here, it does connect to the all-time highs, similarly to the one that I showed you earlier on the S&P 500. But we did have another rejection off of this channel as of recent, all the way back here on March 1st, and it's been unable to reclaim the channel again, partially due to the dollar's recent strength. So I'm very interested to see how the dollar closes this week, especially. Now, the main thing that I'm looking at is the S&P 500 to have a rejection as of this week, at least on the weekly candle, but also the Dow has been relatively weak in comparison to the S&P 500 as well as the Nasdaq, and we are trading below this previous channel. So there is a lot more potential for weakness, especially for the Dow here for further downside. And of course, this would weigh on the rest of the market if this were to be the case. Also, along with the Dow, one of the other large indexes, the Russell, has been relatively weak as well. It's been unable to catch much of a bid lately. Really been consolidating for a long time now, all the way since the middle of March after the whole bank fiasco occurred. So really, this is just a tech-heavy market right now. We've seen a lot of strength overall in the Nasdaq, as you can see here for NDQ, just been on a tear lately. And an interesting point with that, we actually saw record call volume as of Thursday of last week. We have not seen that kind of volume in calls since all the way back when they were pumping the market full of stimulus, just the economy in general. So typically that is a contrarian signal. Whenever you see that much call volume, it tends to be the sign of a potential top. Whether it be minor or major, we will find out soon. However, it seems that Thursday was a major squeeze day, and if that is a contrarian signal that remains constant, we will likely see some form of rejection soon as this week for Nasdaq. And of course, if Nasdaq sees weakness, the rest of the market is just going to fall apart because this has been carrying the entire market for quite a while now. But regardless, continue to watch the VIX call flow that I showed you here, as well as the dark pool levels. Remember, what we saw on Friday, 5.3 billion in premium at this 419.21 level, as well as the Thursday and Wednesday prints, very critical. We did close the week just slightly below this level. If we close the week again below this level, which is my expectation, that can lead to a lot more sell pressure because, again, very unlikely that an institution was buying this much premium at the top of a rally. These are likely very large sells, so keep that in mind going into this week, and I will see you guys next time on Wednesday.